Monday's launch of East Africa's first listed exchange-traded fund at the Nairobi Securities Exchange was the culmination of years and years of work in setting up a functional derivatives market in the region. Now, the launch of the derivatives market has been repeatedly pushed back for years. When I spoke to the CEO of the Nairobi Securities Exchange earlier today, I asked him what triggered these numerous delays and what opportunities finally have come to market, especially for institutional investors.
We've had to engage a lot with the regulator, the Retirement Benefits Authority, to open up an asset class category for such products. And I'm glad to say that last year they did approve broadening the equity asset class to incorporate ETFs and creating a specific asset class for derivatives.
Right. So when you talk about derivatives, what exactly does that allow pension funds to jump into? Currency forwards,
yes,
equity forwards, and so on.
So we do have a derivatives asset class within what you call Schedule G, the RBA investment guidelines schedule. And that now allows pension schemes to allocate up to 5% of their assets to derivative contracts. It doesn't limit the type of contracts. Basically, it just provides a broad definition of a derivative contract. And so you could go into currency, you can go into single stock, index. Yeah, so it's basically just opened it up for contracts which are tradable on the exchange.
Just to step back though, I mean, we've been talking, as you mentioned, we've been talking about derivatives in this country for a really long period of time. And a lot of us who are sitting on the other side of the fence are saying, I mean, every time we'd meet you, this is the question we ask you. So derivatives, when are these things coming to market? But there's a lot of work that's gone on behind the scenes to actually get just to this point. What sort of work was involved?
Being a totally new market, it involved developing an infrastructure that is totally away from the current infrastructure we have. I mean, we had to actually engage with our technology providers to come up with systems. And these systems had to have some level of customization for our local market. So it's not like you get an off-shelf system and straight plug and play. No. Because of the regulations that we have, which could be probably different from what other regulatory environments approach. Let me give an example. In other markets, this is not a pre-funded market. It's actually contracts trade and then settlement cycle starts. In our market, we can't have trading on a non-pre-funded market. So you have to have a mechanism where you fund the account before you actually start trading the contract. Now that creates a whole new dimension of how the systems will be structured.
Because it's almost essentially turning the entire trade on its head.
Yes. So you also have another example. Other markets do not have a separate custodial function. Today, if you want to trade even our equity securities, there's a separate custodian who is a non-trading member. While in other markets, these are actually trading members. So again, another subset, sub-infrastructure has to be created around there. So there are a lot of those tweaks that we had to put into infrastructure.
Okay, now that a lot of the groundwork has been done, and I'm making an assumption in that question, because the ETF has been launched, it's trading. Does that make the subsequent launches of any future products, currency forwards, index forwards, and so on and so forth, a lot easier? For
the derivatives market, once we launch the first contract, they all trade in a similar way. We don't have to now go probably just get approval for the type of contract you're bringing on board, but in terms of the mechanics of how the products trade, the flow of funds, how the margins flow from one end to another, that's all the same. So we don't see any additional infrastructure spent towards creating an infrastructure unique to a particular instrument.
And the regulatory framework is basically the same?
It's basically the same. It's only that now, for instance, equity contracts, index contracts, that's a CMA space. If currency contracts, you need the CBK to get involved.